Hello friends, Rahul again. So today I'm going to deal with the third part of the chapter of the economic survey, monetary management and financial intermediation. So in the last lecture we have studied various topics like bank, credit, NPAs, etc. Uh, but today we are going to deal with a little bit more about some other things like financial inclusion. So moving forward. First of all, what steps have been taken by the government for financial inclusion and what effect it has had on the people required to be financially included? First of all, the number of new basic saving bank deposit accounts rose considerably during the year on account of government's initiative under the Pradhan Mantri Jan Dhan Yojana. You already know that the under the Jan Dhan Yojana, more than 20 crore accounts have been opened, but it is quite another thing that half of the accounts are empty and banks have to pay 200, not have to pay for maintaining that account, they have to pay 200 every year. So moving to the next point, there is rise in number of banking outlets and most of them have opened in the rural areas. There is rise in the business correspondent information and communication technology transactions in BSBDA accounts. Now, what is this BSBDA account? BSBDA account are the accounts which be subject to some of the conditions like total credits in such account should not exceed 1 lakh rupees a year. Maximum balance in the account should not exceed 50,000 rupees at any time. The total of the debits by way of cash withdrawals or transfers should not exceed 10,000 rupees a year. Foreign remittances cannot be done except if they have done the account holder has done the KYC formalities. So these some kind of restrictions are there on these accounts. So what do you mean by this business correspondent ICT model that I'm talking about? Here what we have is the banks keep a person dedicated to meet the people in rural areas where we do not have brick and mortar branches. So the banking correspondent or the business correspondent, what he does is it goes to the home of the individual account holders and gives them various options to even to deposit money or to take out money or to get loans, some etc. Many facilities are given by this banking correspondence. Like it is kind of door-to-door delivery or door-to-door correspondence. So let's move to the next point. There has been increase in the brick and mortar bank branches. So what we see is the increased bank penetration throughout India. Also, what we see is that state level bankers committee convener banks have been advised in December to identify villages with population more than 5,000 without and scheduled commercial banks branch. And the next point is what will happen is that Pradhan Mantri Jan Dhan Yojana has been launched for providing finance to the informal sector micro enterprises, and it has been launched on 8 April 2015. Now this Mudra or Micro Units Development and Refinance Agency have been made under the PMMY or Pradhan Mantri Mudra Yojana scheme. So this Mudra is a new institution set up by the government to provide funding to the non-corporate, non-farm sector income generating activities of micro and small enterprises whose credit needs are below rupees 10 lakh. Okay, the maximum loan that these informal income generating enterprises can take is 10 lakh. So Mudra is essentially to refinance the last mile financiers. Wait a second. So this Mudra is essentially to refinance the last mile financiers. Now Mudra seeks to offer refinance products having a loan requirement up to 10 lakh and support to microfinance institutions by way of refinance. I will tell you something like see here, what will Mudra do is it will lend to microfinance institutions. These are the institutions like NBFCs which give loans to the microfinance industries or informal income generating units like Lijjat Papad, that if you would have eaten that, it is a microfinance company. So this will give to microfinance units. So first of all, Mudra will finance this and MFI will finance these units. So it is refinancing because if MFI doesn't have money to finance the units, it will have to take from Mudra. Fine. So let's move ahead. Now the products designed under this scheme are categorized into 3 buckets. First of all is the Shishu. Shishu means a small child. So this means the loans which are very small, like till up to 50,000. Then there is Kishore. Kishore means after the infancy stage, he becomes a child. It is between 50,000 to 5 lakh rupees loans. And then there is Tarun. Tarun is from 5 lakh to 10 lakh loans. So this is based upon the stage of growth of micro business units. Obviously, if you have a very small unit, you should not take loan more than 50,000 rupees. And most of the units in India are very small. So government has allocated 60% of the loans to the Shishu compartment. Now the PMMI aims to provide the formal bank credit to more than 5.7 crore informal sector micro enterprises and many more aspiring micro entrepreneurs in the country. Now see, they are huge in number. Most of the manufacturing are done by these micro enterprises in our country. Now all non-corporate small business segment comprising of proprietorship or partnership firms running as small manufacturing units or service sector units or shopkeepers or fruit or vegetables vendors, all those are eligible for assistance under this Mudra or PMMY scheme. So bank branches would facilitate loans under Mudra scheme as per the customer requirements, and loans are collateral free here. So let's move ahead. Now coming to the non-banking finance companies. Based on the liability structure, non-banking finance companies have been divided into 2 parts or 2 types. First of all, deposit taking. These companies are allowed to have deposits, and other one is the non-deposit taking non-banking finance companies. Now these deposit taking finance companies, non-banking finance companies, are only 212 in number, and non-deposit taking one are huge, approximately 11,500. Now NBFCs account for 14.8% of the scheduled commercial bank assets and 0.3% of scheduled commercial banks deposit. Now you need not know this data. This data is only to tell you that there has been rise in the loan taking of the NBFCs. Now where does the money of these NBFCs deposit taking come from? Obviously it comes from the banks. In spite of the decline of the deposit taking NBFCs, obviously you see above, there is 212 deposit taking NBFCs after the RBI started regulating them. Before they were huge in number, and then even then they are increasingly giving more and more loans and also taking more loans from the banks. Now there is other type that is called non-deposit taking NBFCs. The economic survey says that there are some systemically important non-deposit taking NBFCs which have expanded significantly, that is by 16% by end March 2015, and loans and advances which formed a part of their assets also grew by 15.5%. Now these are systemically important because they have much leverage in the market, or they have widespread loan giving in the market. So these these NBFCs which are systemically important and are non-deposit taking get their resources mainly from floating debentures, borrowing from banks, commercial papers and intercorporate borrowing. Now these terminologies will be dealt later by my colleague, but this is just to tell you about the various sources of money or resource which comes to the non-deposit taking NBFCs. Now let's move ahead. Now we have to see the development in the government securities market, but here economic survey has given a lot of data which is not required at all, but I will discuss some terminologies which are very important for the point of view of pre-exam. These terminologies are as follows. First of all, yield. The yield of a bond is inverse to its price. For example, as bond price increases, bond yield will fall. For example, assume that an investor purchases a bond with 10% annual coupon and a par value of 1000 rupees. What do you mean by this is, suppose the cost which you incur in buying a bond is rupees 1000 and you will get an interest of 10%. That I am talking about, this coupon, annual coupon I am saying na. So this 10% over a year will be 100 rupees. So after a year you will get 1100 rupees. Okay, but because of market fluctuations, now what happens is the bond price has decreased to 900 rupees. This was 1000 rupees. Now you bought for 900 rupees and the price is still 1100 rupees at the end of the year. So when you will divide this 1100, you will get more interest. 11.1 interest you will get. How this 11.1% came is 100 by 900, because now you bought for 900 into 100. So 100 by 9 is 11.1%. Okay. Now coming to the next terminologies, that is buoyancy or buoyant market. It is a market that experiences plenty of trading activity and on which prices is increasing rather than falling. Hence it is referred to as buoyant market. Now coming to the next topic, development in the capital market. Now capital market, we have two types, primary market and secondary market. In primary market, there are few terminologies. First of all, I have to deal with the public issue. You might have heard of the initial public offer. So under this method, the company issues a prospectus and invites the general public to purchase shares or debentures. So this is called public issue. The second one is right issue. In this method, the companies who have already issued their shares, they are using it. So when an existing company issues new shares, first of all it invites its existing shareholders. So in this case, the shareholder has the right either to accept the offer for himself or assign a part of it to another person. Okay, so this is the right issue. The next one is the private placement. Under this method, the company sells its shares or securities to the institutional investors or the brokers instead of selling them directly to the public. Thus, in turn, it sells its securities to the selected clients at a higher price. This is a preferred method for companies as it is a cheaper one, because the raising of funds happens very cheaply as compared to the public issue, because for public issue they have to hire an underwriter, but here they can deal personally too. So let's move ahead. Now very important thing is small and medium enterprises platforms of the stock exchange is intended for small and medium sized companies which have high growth potential and whose post issue paid up capital is less than or equal to rupees 25 crores. Now what this means is, I have to tell you about the paid up capital. Now a company issues a capital of suppose 400 crore rupees, and many people apply for it, but finally the company gives only 250 crore rupees shares, or 250 crore rupees shares are subscribed. So and the money is taken by the company from the shareholders. So this is paid up capital, okay, and they are getting the money with the help of market. So the economic survey shows this table, and it is telling about the resource mobilization of primary market. You can easily see that the debt has very less contribution to the primary raising of resources in the primary market, but equity has a huge lot of role in the raising of resources. See, in the 2015-16 financial year, there is 21,000 approximately 21,000 crore rupees equity which was subscribed to and paid up, and out of which IPOs were approximately 12,200 crores. So this means this is the best method for the companies to raise capital for doing business, okay. And then private placement of corporate bonds, it is also a huge hit here, because you see a 3,41,420 crore rupees of private placements. That is, institutional buyers are contributing much more to the business, okay. So let's move ahead. Coming to the secondary market, there is downward trend in this Indian stock market, because you know there is slowdown in China. There is mixed corporate earnings for the Q1 and Q2 in 2015-16 financial year, because of slowdown of the external environment and the main importers of Indian goods and services. Also there is FPI's concern over the minimum alternative tax. When the ministry or the income tax department sent notices to the FPIs, they were shocked, and approximately 17,500 crore rupees of money was taken out of the Indian market. The next point is the weakening of the rupee against the US dollar. So that is also creating a lot of turbulence in the financial market or Indian share market. Also there is investor concern over the delay in the passage of goods and services bill, which is leading to less investment in our country and has less enthusiasm in people. Also there is uncertainty over the interest rate hike by the US Federal Bank and selling by the FPIs, because when the US increases the rate of loans or increases the interest rate on loans, then the FIIs or FPIs leave India, because they have taken loans at that cheap rates in the US. When the loan rate increases, they want to return the loans back as soon as possible. So they take out the money from India. By the way, why they invest in India? They invest in India because India, being a developing country, has a very much higher growth rate than the other developed countries. So to make a quick buck, they invest in India. But however, in spite of these setbacks or problems, Indian equity market has been very resilient as compared to other emerging market economies. Now let's move ahead to the new gold investment schemes which government has proposed to bring in. So government has launched sovereign gold bond schemes and gold monetization schemes on 5th of November 2015. So the main objective of these schemes are to reduce the demand for physical gold and shift a part of the gold imported every year for investment purposes into financial savings. Now there are two schemes. First one is sovereign gold bonds. Now these bonds are issued by the RBI on behalf of Government of India in rupees and denominated in grams of gold and restricted for sale to the resident Indian entities only. It is both available in the paper form and also in demat form. Demat means dematerialized form. The minimum and maximum investment limits are 2 to 500 grams of gold per person per fiscal year. So this is for 8 years, but exit can be made from 5th year onwards. KYC norms are the same as that for gold, and exemptions from capital gains tax is provided. And government is also thinking about linking it to inflation. Now coming to the second scheme, gold monetization scheme. Now here the Bureau of Indian Standards certified collection and purity testing centers collect the gold from the customer on behalf of the banks, because many people have in India a lot of gold and they keep it in the lockers, and even if they don't use it, they keep it with them. So what the government does is takes that gold and brings it into the market where they can be kept, or they can be given to the jewelry industry for melting and again making some new ornaments or jewelry. So the minimum quantity of gold which can be deposited in this scheme is 30 grams and there is no maximum limit. Gold saving account can be opened with any of the branches, and denomination in grams for gold for short term period is 1 to 3 years. A medium term period of 5 to 7 years and a long term period of 12 to 15 years. Now the banks will have a tripartite agreement with these collection and purity testing centers and refiners. Refiners are those people who get the gold from these purity testing centers. Okay, so the banks, the testing centers and refiners have an agreement that how to use this gold. Now the money can be given back in this scheme also, and also gold can be given back, but it is only for short term. If you deposit your gold for long or medium term, that then the return only will be made in the form of cash. Okay, so let's move ahead. Coming to the institutional investments. Now with the objective of putting in place a more predictable regime for investment by foreign portfolio institutions, the medium term framework for FPI limits in debt securities have been laid out. You should remember that it is for debt securities. Previously the FPIs were not allowed to invest in debt securities. Now they can invest in the government bonds. Now what the RBI has done is, it is trying to make a staggered opening of the debt market to the FPIs. FPIs include FIIs and qualified institutional buyer. These both of the institutions, or this is individual and this is institution, these both have the short term interest to make profit and from the company in which they invest, and are now not involved for long term. So the limits for FPI investment in debt securities will be henceforth announced in rupee terms. Okay, the limits for FPI investment in central government securities will be increased in phases to 5% of the outstanding stock by March 2018. That is, out of the total securities which will be given by the government, 5% can be given to the FIIs. So what will happen is, it is ease of the burden on the banks, because bank have to maintain the 21.5% of the capital in the form of government bonds. So now the RBI can hence decrease the percentage of bonds which have to be kept by the banks. Okay. So let's move ahead to the next topic, external commercial borrowings. Now the RBI has, in consultation with the Ministry of Finance, have put in place an ECB framework or external commercial borrowings framework. So it has divided the borrowings into three buckets. First of all, it is the medium term foreign currency denominated ECBs. It is in medium term and foreign currency denominated. So it is for short term projects, like for 5 to 6 years maximum. Then there is long term foreign currency denominated external commercial borrowing. These long term borrowings will have a minimum average maturity of 10 years. Then there is Indian rupee denominated external commercial borrowing. So there are three types: medium term foreign, long term foreign, and Indian rupee denominated ECB. Right? So the new framework has an expanded list of recognized lenders. That is, many other institutional investors or lenders have been included in the new framework, which will help the Indian companies to get ECB loans easily. As you also know that LIBOR, London Interbank Offered Rate, has been low. In the developed world, the loans are given at dirt cheap rates. So this will be helpful for Indian investors. Thank you everyone. Please like, comment and subscribe to www.decipheris.com, and please like our Facebook page as shown. Please give reviews. This will help us improve and continue this initiative.